Welcome to Heresy Financial, everybody. This is the channel where we discuss financial topics in a way that's considered heresy to the financial establishment. Today we are going to be discussing an update on what's been happening with the repo market lately. If you watched my last video, I discussed the first couple of days what was happening. Today we're going to do an update to dive a little bit deeper into looking at what happened then and why it's still going on. Let's dive in. All right, guys, so if you haven't watched my last video, I would suggest watching that one before this one because I took a lot of time in that video to describe and explain how the repo market actually works. And so today I'm going to do just a very brief overview of how that repo market works. So if you want a little bit of a deeper dive into that, go ahead and watch that video. In short, the repo market is the lending market of short-term cash in between banks. So if you or I, if this was, using you and I as an analogy, let's say at the end of the day, you've spent more money than you actually have in your account. You could go to your friends and say, hey, let me borrow some cash, and then I'll pay you back the next day. In return for borrowing that cash that you're going to pay back the next day or the day following, you might say, hey, let's sign a piece of paper and you currently have temporary ownership of, this expensive painting on my wall or part of my car, or part of my house, or my tool set in my garage, something that has some value. That way, if I don't pay you back, you can take the collateral and you can sell it, or you can just keep the collateral. And then when I repay you the cash the next day, you're able to take that and then we just swap back what I initially lent to you in return for that cash. So I repurchase, basically I repurchase that thing from you that I loaned to you as collateral while I took that cash. So it's called a repurchase market or a repo market because in exchange for cash, I'm promising to repurchase the collateral that you are holding on to in the meantime. So banks do this with each other, and it's a market that is largely dependent on trust between banks because the collateral that's being put forth is supposed to have value in order to accomplish the status of collateral against the short-term cash. Now, the Federal Reserve sets the interest rate that they want this market to operate at. They don't allow, if this was a free market, it would just be determined by whoever the bank was, what their collateral was, and the Federal Reserve does not allow the free market to actually determine what the interest rates should be on anything, so they set this interest rate themselves. Well, last week they lost control, and ironically, it was right at the time when they were coming out with the, announcing that they were cutting interest rates again. Monday night last week, the interest rates in the repo market spiked. They're supposed to be around 2%. They spiked up to about 10% at one point. And so the Federal Reserve had to inject a bunch of money into the system. They had to become the lender of last resort. They had to print new money, create new money out of thin air, and offer it in at the rate that they want that market to operate at, which is about 2%. So they offered new cash to the tune of $53 billion that first night. I believe it was $53 billion. And the news caught wind of this, and everybody just said, "Oh, there is a liquidity crunch. Banks didn't have enough cash to lend to each other. All the banks needed cash at the same time, so none of the banks were willing to loan it." And it was, they said it was due to, there were, quarterly tax payments coming up by institutions and bond settlements all happening at the same day. They said, it was just a crunch of cash, very short-term, temporary, and so the Fed had to come in. Well, happened again the second night. On Tuesday night, $75 billion they had to inject into the system. The third night again happened again, and guess what? It's still happening to the point where a couple of days ago they announced they're going to continue to be putting $75 billion every single night into the repo market until October 10th. That's weeks of printing money out of thin air to inject into the repo market. So there are systemic issues going on here. This isn't normal. In my last video, I talked about the last time the Fed had to intervene in the repo market was 10 years ago. Back when all of the collateral that all the institutions had were these mortgage-backed securities, these collateralized debt obligations. So all the banks realized, hey, this collateral that you're putting up, you want my cash, you're offering me this collateral, there's our mortgage-backed securities and all the mortgages are bad. So this collateral isn't worth anything, so I'm not going to lend you my cash. And so all of a sudden this lending and borrowing dried up. And so firms like Lehman Brothers and Bear Stearns and AIG that relied on, they didn't have enough cash to fund their daily operations. They relied on this market. Nobody would give them the cash. And so they went bankrupt. The Federal Reserve and the government realized, hey, this is systemic. All of the other institutions are invested in the exact same things. Nobody has enough cash to fund their daily operations. And these are the banks that supply the funding for all of the other companies in America. And so this is like a chain of dominoes. As these financial institutions, they're going to start to fall over because none of them have enough cash. They're not lending to each other. And pretty soon, all the other companies that rely on the financial institutions for cash to fund their daily obligations, they're not going to be able to fund their daily obligations either. And so the Federal Reserve stepped in and rescued. They started injecting a ton of cash into the system. They started printing money to be able to make sure that everybody, all the banks, the financial institutions had enough money to not just be knocked over and go bankrupt. So this is a big deal when the Federal Reserve intervenes in the in the repo market, because it communicates a couple things. There's a lack of trust that for some reason banks aren't lending to each other as much as the demand is. Number two, it shows that there might be a big liquidity crisis. There's not enough cash in the system. It also shows that there might be a lack of quality in the collateral. So we're going to dive into a couple of these things because obviously it's not just a short-term cash crunch, or otherwise the Federal Reserve wouldn't have said we're going to do this till at least October 10th. This is huge. None of the major news none of the major news sources are covering this for some reason. And I don't know what it is, but I have a feeling that it's probably due to the fact that they don't want anybody to really know about this, because the more people know about these major things happening like this, the more scared people might become. And if everybody starts selling and then withdrawing from banks, you could cause the panic that they're trying to avoid in the first place. Again, you can't really avoid this. Nobody can actually violate the fundamental laws of money forever without consequences, but they're trying. They're kicking the can down the road, and they think that as long as they keep the American public with their head in the sand, then they can delay this as long as possible. So one of the first things that we know could be causing this is that banks and financial institutions today have things called collateralized loan obligations. Now, if you saw The Big Short, the movie that came out a couple of years ago about the crisis 10 years ago, you saw they were talking about these mortgage-backed securities. They were collateralized debt obligations. They were just basically a big package full of a bunch of mortgages, and they would produce this package full of these mortgages, and the package itself was an investment that produced an average of the income of all the mortgages that were inside of it. And then they had they basically had levels. So in the top level, if any of the mortgages in the top level failed, well, then they would just swap out that bad mortgage with a good mortgage from another level. And basically the package at the bottom was the one that got all of the failed mortgages to begin with. And then if that one filled up with all the failed mortgages, then the failed mortgages would start to go to the next one. And so in the beginning, you had these, the bottom level packages were graded pretty highly. I think they were rated like BBB. It should have been rated F. Like these were things that were basically guaranteed to fail, because of all the mortgages out there. Anytime one failed, it went straight into that bottom one. And so you have a system in place where these bottom packages were basically guaranteed to fail. And so you have these packages where the top ones, they were considered to be very, very safe, because if any of the mortgages inside them failed, they would be swapped out. And so they were, at the top, they were basically guaranteed to be the last ones to fail if all of the mortgages started to fail. Well, as this whole entire kind of housing market collapsed, you had each of these levels start to get hit, and people who were in the know, if you watch the movie, the people who were kind of early adopters, they basically guaranteed that they knew that the bottom ones were guaranteed to fail, and so they would short those. A lot of people didn't realize that some of the higher levels would start to fail as well. So that was what happened 10 years ago. Those were the packages that the financial institutions had as collateral, that all the other institutions realized, hey, this isn't worth anything anymore. We're not going to give you cash against this because this is garbage. So today, financial institutions have created very similar instruments called collateralized loan obligations. And instead of mortgages, these things will have corporate loans to small businesses that are considered high risk. but they're producing as long as the economy is getting better. But if the economy starts to turn around, well, all these small business loans and risky business loans will start to, well, they'll default. So you've got these packages of corporate loans that are structured in a very similar way to the way these mortgage-backed securities were 10 years ago. Another thing that you have, the same exact structure with auto loans. Now, I've talked about this in the past, I've written some blog posts about it, but auto loans are starting to default at the highest rate in a very, very long time. The average car loan in America right now, I think, is $535 a month. The average median household income is only like $56,000. And so right now you have a vast majority of people driving cars that they can't afford. And they're starting to default on them, shockingly. When people spend money they don't have the money to spend on it, so they can't spend the money, and so they default on that loan. And so you have these packages of auto loans that are now starting to default. Another way that these structured these collateralized loan obligations is by putting student loans inside of them. And guess what is one of the biggest bubbles right now in the financial industry? It's student loans. Student loans are starting to default at higher and higher and higher rates. And so as you have these packages of student loans start to default, you could have any one of these three causing a lack of trust in the collateral that banks are offering to each other. And so you have a cash crunch because they're not willing to offer the cash to each other because they realize that the collateral that is being put forth in order to borrow this cash is basically not worth it. And so those are the main three things that could be coming up. The last thing that could be a cause of a major liquidity crisis is something called a synthetic ETF. Now, most people have heard of ETFs. They're exchange traded funds. It's kind of like a mutual fund, except you can trade it throughout the day. You don't have to just wait till the end of the day to have your trade executed. It trades on the exchange at the bid and the ask. The price fluctuates throughout the day. Independent of the net asset value because it's supply and demand of the actual shares. Whereas a mutual fund, you're putting your orders in directly with the mutual fund company and they execute every day at the net asset value. If you don't know what any of that means, don't worry about it. It doesn't really matter. But an ETF is just something that gives you the exposure to the market. If you want to buy and sell any index throughout the day, ETFs will allow you to do that. Now, there's something called a synthetic ETF. Now, a synthetic ETF is different than a regular ETF because with a regular ETF, when you buy shares of that ETF, you're basically getting the price movement of the average of all the companies that are inside that ETF. An ETF is a package of different stocks or different investments. And so if you're invested in an S&P 500 ETF, well, that ETF is just taking all of its money and purchasing shares of the S&P 500, of all the 500 companies that are a part of the S&P 500. Well, a synthetic ETF doesn't do that. A synthetic ETF tries to mimic the price movement of the underlying index, but it does that in a very different way. What it does is it holds mainly cash or bonds or something very conservative, and then uses a small portion of its assets and trades derivatives, things like options and futures. These are contracts that basically are highly leveraged. So if a stock, say Amazon, moves up 1% in a day, a derivative, an option on Amazon might move up 5% in that day or 10% in that day. And so you'll have ETFs that will hold a large amount of cash and then use a small amount of that cash in order to buy and sell derivatives. They'll buy and sell puts and calls on all the stocks of that index in order to replicate the price movement of the index. Now, you might be wondering, why would anybody do this? Number one, why would an ETF company decide they want to invest this way? And number two, why would anybody choose to invest in an ETF that's doing that in the first place? What's the advantage? Well, the advantage is limited loss. Because if the stock plummets and you just own the stock, if the stock, let's say Tim Cook walks away from Apple tomorrow, or Jeff Bezos walks away from Amazon tomorrow, or Elon Musk for some reason, he tweets something crazy again and he's fired and he's no longer able to participate in Tesla. There's a good chance that those stocks without their leaders would 50% drop in one day. Would not be an unreasonable expectation because those are companies that rely on what their leaders do a lot. And there are other companies have crazy things happen to them all the time, right? And so if I myself, forget the ETF, if I myself have an account and I have $10,000 in my account and I put all that $10,000 into Amazon, well, Jeff Bezos leaves tomorrow, now my account is worth $5,000. Let's say I've got $10,000 and I want to limit my risk. Well, I might buy a call option on Amazon so that if it goes up, let's say I spent, $1,000 on a call option. Well, if Amazon goes up 10%, then my call option by itself will go up a lot more than 10%. But my account overall will grow by 10% because most of my account was in cash. So the $1,000 that I invested in Amazon, in the call option on Amazon, it might double. It goes from $1,000 to $2,000. Well, now my account overall went from $10,000 to $11,000. Amazon went up 1%. My account went up. That's 10%. Amazon went up 1%, my account went up 10%. And so you can see the advantage to using leverage. You take a small amount of the portfolio and you use derivatives, and that basically gives you leverage. Well, what if the opposite happens? Well, the opposite happens, Amazon drops by 50%. My call option that I purchased on Amazon just becomes worthless. And so instead of my account value going from $10,000 to $5,000, my account value goes from $10,000 to $9,000 because I only put up $1,000 as my investment. And so there's limited downside when you're using things like options and futures as derivatives. It gives you leverage. So you leverage a small part of the account, and then you leave the rest conservative. So it gives you the overall look as if you're replicating the performance of whatever you're invested in, but you're not actually invested in it. So where's the problem with this? Well, most of these ETFs, and by the way, this market is huge. There are trillions of dollars making up the synthetic ETF industry right now. There are a lot of ETFs that trade this way, which is one of the, when you say who would invest in an ETF like this, probably you. You'll have to go read the prospectus to make sure that they're not doing this if you want to stay away from an index fund like this. And so it's huge. There are a lot of ETFs that are doing this, especially ETFs created by Deutsche Bank. And so you can have an ETF that's invested like this with limited downside compared to the actual investments that they're replicating the performance of, but they have all of the same upside because of the leveraged part of their portfolio. So where's the problem with this? What are these ETFs doing with all that cash? Well, they have them in banks. Well, they own bonds. Well, what do banks do with their cash? They use it. That's the fractional reserve system. So banks aren't just holding on to 100% of the deposits that they have on deposit. They keep, let's say, 10% of that on deposit, and they use the rest for their own investing. And so a large amount of the money that's actually in the system is not money that's actually in the system. It's all just IOUs. Because as soon as these ETFs realize, hey, there's a cash crunch, meaning that the Federal Reserve is having to input cash into the system to make sure that these repo market rates don't skyrocket, they're starting to realize, hey, there's a cash crunch in the system. We need to scale back, because what if there's a systemic problem here? And what if there's a systemic run on the banks overall? Well, all of the financial institutions understand there's nowhere near enough cash in the system for all redemptions to be made at the same time. That's the old classic problem of runs on the bank. Everybody wants their money at the same time. The bank doesn't have the money. The bank shuts their doors. That was why the Federal Reserve came into the picture in the first place, because they said, hey, we don't want one bank to have to fail, so we'll take on the risk. And now the only way that anybody can get hurt is if everybody gets hurt at the same time. So they transferred risk from small to everybody. which is not a particularly great way to run a system. It makes the whole entire system weak instead of just leaving individual nodes weak. It transfers all that risk to the system. And so that's how our financial system actually works. All the institutions have their risk transferred overall to the entire system. And so these synthetic ETFs could very well be looking at this and realizing there is a shortage of liquidity. There's not enough cash, so we need to restructure our investments, because if everything falls apart, then our conservative portion, our cash, might not actually be there. And so that could be causing some of this, because they're starting to redeem some of those deposits and restructure their investments, restructure the way they have their portfolios. And that could be causing a massive drawdown on cash, making the Federal Reserve have to continue this this injection of brand new money into the system. And so all of this, what this causes is inflation. This is just brand new money being pumped into the system that the Federal Reserve is creating out of thin air. This does not bode well for the system right now. This does not communicate confidence. The Federal Reserve has lost control. That's why they have to keep on doing this, because the interest rate's not staying where they need it to. And we'll have to see how this unfolds. This could very well lead to or be a sign of giant systemic problems that we're only now starting to see. So stay tuned. I know that's kind of a doom and gloom message for today, but I want to give you an update on kind of what's happening and what are some of the bigger things that could be happening behind the scenes, causing some of these things to unfold. So I'm not positive if it is the auto loans or the student loans, maybe it's credit cards, or if it's business loans, or if it's the synthetic ETFs, maybe it's kind of a combination. It could also have to do with some of the things happening in Europe right now. Some of the things happening with China. It could be a massive mix of everything going on right now. So stay tuned. If you are looking for something more actionable on if you expect this might start to unravel the system, what to do. Well, 100 years ago, right before the Great Depression, I would have been telling you, sell your stocks and go to your bank and withdraw your cash. But everybody thought advice like that was absolutely stupid, because the bank has my cash. Why would I need to withdraw it? But when the Great Depression actually happened, nobody actually had the money they thought they did. Today, it's the same thing, except cash is the problem. And so that's why you buy gold. That's the same thing as selling your cash, because as inflation takes off, cash becomes worth less. The dollar specifically becomes worth less. Currencies that are backed by nothing become worth less. And then as the world starts to catch on that these problems are kind of isolated in, or they're sourced from America, they're going to start dumping the dollar. There's a lot of dollars overseas right now. So all the inflation, the trillions of dollars we've exported overseas over the last 10 years, is going to start coming home. And that's going to start bidding up the prices of everything here in the States. And so make sure you're invested in real assets that have, they benefit from inflation. Because as costs and prices go up, things like rental property costs go up as well. And so rents go up. Things like gold will go up. And so make sure you're investing in hard, real assets. If you're invested in stocks, that's going to be better than being invested in bonds, because there are going to be some companies that go bankrupt, but they're not all just going to default like could happen with the debt. And so I've got a lot of other material that's kind of a sweeping overview. This is not hard and fast financial advice specifically, or investment recommendations for any one person. So take it with a grain of salt, do your own research, check out some of my other material on my podcast. I've got a book on Amazon. It's called Financial Heresy. But I'm hoping that this gives you a little bit of a brief glimpse and a window into what's going on. Stay tuned. I'll come out with more videos as things unfold. Thank you so much for watching. And if you enjoyed it, please like and subscribe. Have a great day.